Opinions expressed herein are subject to change and not necessarily the opinion of the firm. Past performance is no guarantee of future results. The information presented herein is for informational purposes only and is not intended to provide personal investment advice. It is important that you consider your tolerance for risk and investment goals when making investment decisions. Investing in securities does involve risk and the potential of losing money. The material does not constitute research, investment advice, or trade recommendations.
And now introducing Mr. Keith Lanton.
Good morning. Hope everyone had a fantastic weekend. August 24th, as we march through this unusual summer. Going to get started this morning. Talk about some habits that, if adopted, hopefully will make us more productive and more successful. I'm also going to talk about financial markets. Lots going on as always. We see a continuation of the themes that have been playing out over the summer. They're continuing here into late August, and we're seeing a perpetuation of what's taken place really since COVID began. Lots of financial industry participants that were struggling or weaker pre-COVID are in even worse shape now in many instances, and many of the companies that had been the beneficiaries of some of the ongoing trends pre-COVID, such as e-commerce, data security, anything that had to do with remote working, which remember was a trend taking place pre-COVID, has become an even greater emphasis post-COVID. Smaller shops competing against Walmart, Target, Amazon were struggling for many years. That trend has continued as well. We've seen some new trends as well in the COVID world. Keep in mind some of the independent, unique restaurants. Those companies are struggling against the larger, more entrenched chains that have built out larger infrastructure, have larger capital bases, and in some cases have better means of doing things electronically and communicating with customers electronically. So we are seeing shifts there. Also, some of the other shifts we're seeing, of course, related to the travel and hospitality industry, two industries that pre-COVID, anything having to do with rest and relaxation and more leisure time, were benefiting from trends. That would be the one group that I see that there's been a significant reversal, and until there's comfort getting back to travel and work and perhaps a vaccine or perhaps some other event related to COVID will make that change possible. But that's the group that had the momentum and the trends in their favor, and probably would see the greatest percentage change if there was something to change the direction or the trajectory of COVID, where you'd see the greatest benefit. So we're going to get started this morning and talk about 3 daily habits for a life of happiness and success. This is an article that was put out by Mark Mehlberg, and habit number 1 is perhaps the most underrated habit that we could adopt and focus on. Many of us underestimate its importance. In fact, there's an entire book recently written on it, and that is sleep. Recently, a book written, Why We Sleep, by Matthew Walker. Bill Gates had been a big proponent of suggesting taking a look at that book. Perhaps we'll cover it next week or a few weeks after that. But sleep is one of the greatest habits we can form to get a good night's sleep that will give us a tremendous return on our investment in our sleep. When we don't sleep, we're often irritable, perhaps more prone to depression, and many call sleep, Matthew Walker does, the single most important function to a successful day. Those who point to the benefits point out that it's not just something that some people feel, but there is lots of science backing up the benefits of sleep. And studies have shown that lack of sleep is linked to procrastination. Lack of sleep negatively affects your mood, which is linked to a lack of motivation. Study after study has demonstrated that after 17 to 19 hours of no sleep, your brain works as well as it does after a few glasses of wine. If you don't sleep for 24 hours, your brain acts as if it has a blood alcohol concentration level of 0.1, which is considered to be under the influence in all 50 states. Sleep-deprived surgeons are 20 to 30% more likely to commit errors than those with enough sleep. So perhaps if you're going in for surgery, one of the first things you may want to do is check with the doctor and see how his previous night's rest was. So what can you do? Prioritize your sleep every day. Make a habit of getting to bed with enough time to fully recharge your batteries. Otherwise, you'll find yourself distracted by unimportant things that you're focusing on. You might be working on other people's tasks, in which case it's going to be hard to live a happy and successful life. Habit number 2 is exercise, getting the right amount at the right time. Recent study by Bristol University showed that people rate themselves 22% higher levels of concentration on days that they exercise. They say that they are 22% more likely to finish their work. They're 25% more productive without breaks, and 41% more motivated on days when they exercised than on days when they did not. Low-intensity exercise is effective for reducing fatigue, avoiding the decline of attention, memory, and problem-solving. If you work out in the morning, you will give your body an energy boost and flood your system with endorphins, which is what your body needs to be more productive and happier. Exercise is a habit. It's something you feel either compelled to do or you feel is an interruption. Given the benefits, you need to make sure you are feeling that it is a habit. And finally, the third habit here from Mr. Mehlberg is prepare for your moments. Every day is made up of moments. Moments, you can think of them as the building blocks, or more simplistically as the moments of your day, the little Lego moments of your day, little Lego building blocks. Moments are the building blocks of either happiness, despair, success, or mediocrity. So why on earth do we go from one moment to the next without having a plan of how we'll get the most out of each moment in time? Most of us recognize that if we're having a meeting and that we're having to present, that we have to prepare. Also, most of us recognize that if we have to be at a meeting at a certain time and we're anticipating heavy traffic, we have to see what the traffic patterns look like, and we have to plan ahead in order to arrive on time. So why should anything else we do be different? If we were simply to prepare for each moment that is significant, of course we can't prepare for every single moment of every day, but if we prepare for what the big moments of the day are, we will see a lot more success. Number one, you'll see that you're more likely to reach your goals when you imagine the outcome and plan backward the steps it will take to get there. This is something Tiger Woods says he does before every single hole when he's in a major tournament. He envisions what the shot's going to look like, and then he works backwards. He pictures the entire hole, which club he's going to use, where the ball's going to land, works backwards in order to derive his success on the golf course. Knowing what you'll do in advance helps you avoid decision fatigue. Science has shown that when we have to make decision after decision, we become less effective at making the next decision. We get tired of making decisions. Interestingly, if you follow the average, you'll need 17 minutes of rest for every 52 minutes of work. So when you're resting for those 17 minutes, if you were to plan ahead what you're going to be doing for the next 52 minutes, you'll see a lot more productivity in those 52 minutes as opposed to stumbling around and possibly doing someone else's work. Perhaps you will be multitasking, which is shown to be far less effective. So 3 key habits to think about every day: getting that sleep, getting that exercise, and planning for those moments. Now to talk about where we are at this moment in financial markets. Taking a look at last week, we saw the S&P 500 was up just under 1%. Dow roughly unchanged, but up 0.9%. The Nasdaq was up 2.7%. International markets down 1%. Foreign emerging markets were down 0.1%. On the week, Treasury bond prices were higher. 10-year Treasury for the year is now up 10.9%. Municipal bonds on average for the year are up 3.7%. Municipal bonds were down 0.3% last week. What do we have going on this morning? Where are we right now? Global stocks gained on Monday. Today, as President Trump signaled he would take an aggressive approach in pushing medical treatments to fight coronavirus. Nikkei up 0.3%. In Tokyo, the Hang Seng in Hong Kong up 1.6%. European stocks are rallying. The French CAC 40 is up 1.7%. We are seeing futures here in the United States up across the board. We're seeing Dow futures, last I had looked at them, were up about 220. I see they're now up 270. S&P futures up 28.5. NASDAQ futures up 120. Some of this gain having to do with continued strength in Apple. Morgan Stanley raised their price target on Apple this morning to $520, which is about where it is this morning. So we'll see if any further changes are coming there. And we'll talk some more about Apple when we get to Barron's, which talks some more about Apple. Getting back to some of the other news this morning. President Trump accused the FDA of trying to sabotage his re-election efforts and gave the FDA emergency approval for the use of blood plasma from recovered coronavirus patients, which hasn't been proven yet by scientific trials, although some scientists and doctors say it is effective. Markets viewing that positively. Markets also positive on the fact that President Trump may order the FDA to grant approval to the University of Oxford's vaccine, which will be distributed by AstraZeneca. AstraZeneca shares are up 2%. Right now we're in a market that's focused on good news, ignoring more concerning news. President Trump did make some comments to Fox News that we don't have to do business with China. Possibly in a different mindset, markets may have chosen to focus on those words to a greater extent, but this morning that not getting lots of attention. No major news to report this morning on the economic front. The tension is building to the annual Jackson Hole Conference, which is being held virtually on Thursday of this year. Federal Reserve Chairman Jerome Powell is expected to outline the central bank's new inflation strategy. We'll talk some more about that in Barron's. And Bank of England Governor Andrew Bailey will also address the conference. Tencent Holdings shares, the company that trades in Hong Kong, Chinese company, up about 6%. Bloomberg News saying the White House privately assured Apple and Google it wouldn't seek to block those companies from offering the WeChat product outside the United States. WeChat is an app by Tencent, how many people in Asia, in particular China, communicate. And there were significant concerns from Apple and Google if they had to turn that app off, that it may impact their business. Also, obviously, would affect Tencent. Also, shares of BT Group are climbing 6%. Sky News reporting that the BT Group, British Telecom was the former name, that they've asked Goldman Sachs to update their defense strategy against possible suitors there. We are seeing some strength this morning in gold, as well as oil. Both those commodities up. Dollar down slightly this morning. Gold's up $10 an ounce. Oil up 39 cents. Some final other news this morning coming from Delta Airlines. Delta saying that they plan to resume 50 of its international routes this winter. These are flights that were suspended. And Delta also said that they are doubling their staff to handle revamped pre-flight pit stops for deeper cleaning. They want to ensure that tray tables and restroom handles are germ-free with new testing protocols. So bottom line, they still want to be able to turn those planes around as quickly as possible, but they want passengers to feel comfortable while that speed is taking place. Some other news this week to focus on. Tomorrow we get earnings from companies like Intuit, Medtronic, and Salesforce. We get the Conference Board releasing consumer confidence for August. Expectations are for a reading of 93.6. Some other earnings this week, moving to Thursday, we get Dell Technologies, Dollar Tree, Ulta Beauty, VMware, reporting earnings on Thursday. Backing up to Wednesday, we get Durable Goods for July. And then on Thursday, we get the National Association of Realtors, pending home sales. Mentioned earlier, Thursday, we have that meeting taking place in Jackson Hole virtually. That's going to get lots of attention based on the commentary from Chairman Powell. And then on Friday, we have the Institute of Supply Management releasing Chicago Purchasing Managers Index for August, and we also get personal income and spending for July. We're going to move on to Barron's, talk about a few different things here, and then we're going to turn things over to Brad to fill us in on markets and also some commentary on fixed income markets. bond markets. So, Barron's talked about the somewhat obvious, or the elephant in the room, and that is Apple. Technology trader column. Apple is unstoppable, and it carried the market to a record high. S&P last week hit a record high, but it's probably fairer to say that Apple stock hit an all-time high, and the index followed. Apple last week was responsible for 60% of the S&P 500's gain after it climbed 8.2% last week. Apple's influence on the Dow Jones Industrial even stronger. The blue chip index last week was barely changed, slightly to the upside, less than 0.1%. Without Apple, which single-handedly contributed 260 points, the Dow, instead of being flat, would have been down about 1%. And Dow also helping charge the NASDAQ higher as well, with a little help from its friend Tesla Motors last week. While tech's leading role in the market moving the market higher, has been much discussed. Apple, at the same time, was battling Microsoft for the title of the most valuable stock. Was basically a neck-and-neck race just a few weeks ago, and now it's not even close after Apple's most recent rally. Market cap there over $2 trillion, and Microsoft's is quote-unquote just $1.6 trillion, which is the widest gap between the two since 2012. What Apple's success can hide, Barron's points out, is that the market itself isn't doing quite as well as Apple. The S&P 500 hit a record last week, but most stocks have been having bad days. On Friday of last week, for instance, just 220 of the 500 stocks in the S&P 500 were higher, and that was far from an anomaly. The S&P 500's cumulative advanced decline line measure of number of stocks finishing higher versus those finishing lower, which technicians use to gauge the underlying strength of the market, has been falling even as the S&P 500 has powered to new highs. Now, Barron's points out that sounds worrisome, but they also look back and quote some studies here from Bespoke Investment Group that poor market breadth hasn't been a warning sign for investors. Bespoke telling market participants that, in fact, just over 10% of the all-time highs in the S&P 500 since 1990 have come on days with negative breadth. Strangely, the index has gained 13.2% during the year following such occurrences, better than the average gain of 11.9% when new highs are made with breadth that is better. The narrow breadth in the market reflects what we were talking about earlier, which is that we are seeing more and more concentration and more benefit, perhaps as a result of some changes that have already been in place and COVID accelerating those changes. So perhaps the lack of breadth and the concentration in the hands of a few, not as surprising and perhaps not as ominous as it sounds. Barron's pointing out that the S&P 500 now trades for 26 times 2020 earnings, 21 times 2021 projected earnings, and 18 times projected 2022 earnings. So some suggesting perhaps that valuations are getting steep, and Barron's said that one strategy that you may want to employ that may make sense for more conservative investors who are getting worried is to consider companies whose dividend yields nicely exceed their bond yields. This can be a good way to find high-quality stocks because low bond yields are often a sign of financial strength and dividend stability. So Barron's went through a list of a few different stocks that meet those criteria. They point to Johnson & Johnson. 10-year yield is 98 basis points, 0.98%. The stock's yielding 2.7%. So Barron's pointing out that if 10-year bond investors are willing to lend the money for less than 1%, perhaps the company's in good financial shape, and that 2.7% dividend yield is potentially somewhat secure. Other companies on the list, Edison International, EIX, the utility company, 2.04 yield on the 10-year, 5% stock yield. Pepsi, 1.24% bond yield, 3% stock yield. Pfizer, 1.3 on their 10-year, 3.9% stock yield. Verizon's 10-year bonds are paying 1.58, and the stock is yielding 4.2%. Going to move on to one stock that was formerly one of the leaders that has not been participating the last couple of years, one we know well, and that is Berkshire Hathaway. Warren Buffett turns 90 on August 31st, continuing his amazing run of 55 years at the helm of Berkshire Hathaway. It is his baby, and he will lead it as long as he can. But whatever premium existed, the Buffett premium that existed, is gone as investors anticipate the end of his reign. Berkshire stock trading at around 1.2 times book value. Its average is about 1.4, and that's despite the fact that Berkshire has been buying back stock recently. The shares remain behind the overall market this year after trailing about 20 percentage points in 2019. But we are starting to see some encouraging signs. I mentioned the stock buyback that started going on in the second quarter, $5.1 billion in buyback. Also, Apple surging stock is a big plus for Berkshire Hathaway. They own about $121 billion worth of Apple stock, or 25% of Berkshire's market value. Investors are also starting to anticipate the post-Buffett era. May remember the grave concerns regarding the post-Steve Jobs era at Apple. Here we have the post-Buffett era that is causing lots of worry for Berkshire shareholders. And it could possibly be a good period for shareholders, Barron says. The company very possibly would initiate a dividend, certainly not a foregone conclusion, but a possibility, something that Warren Buffett has long resisted. Barron's is speculating the dividend yield might be around 2%, and that in the event of Warren Buffett not being there, they would likely continue to buy back their stock. There could also be moves to improve operating efficiencies, focusing on divisions like Burlington Northern, auto insurer Geico, as well as their large utility businesses there. A couple of other stories in Barron's, one having to do with the presidential election and pointing to how a candidate Biden and President Trump may square off against each other. Barron's pointing out that they think that Biden's core economic plan and what he will focus most on is the coronavirus and how he would handle the pandemic differently from the way the Trump administration has handled it, and he's expected to hammer away at that theme in the coming weeks. At the same time, it's expected that the Republicans and President Trump will go after the Democrats for advocating big government programs and higher taxes. President Trump is likely to advocate for his tax cuts, his work in rolling back regulations, and his tough stance on China. Also, we'll discuss the market's new highs, the unemployment improvement post-pandemic will also be things that he discusses. Talking to several different market participants in this Barron's column. Barron's concluded the article talking to an economist at Capital Economics who said that the market may think right now or be pricing in that they do a bit better under Trump than they would under the Democrats, but his conclusion is that the markets right now are factoring in if Biden were to become president, that the biggest fears of big government aren't likely to materialize under Biden, who's been historically more of a moderate, and the market seems to, in his opinion, be taking that tact at the moment. We talked about the Fed and what they may say on Thursday and what they might do. Barron's discussed that with the CARES Act having largely been expired and Congress unable to come up with more help, what can the Fed do and what might they do? And they point to three things we might hear from Chairman Bernanke. One, the Fed may ease terms of the municipal liquidity facility. They have made some tweaks, and the MTA borrowed under that program recently. They may make some more changes to the municipal liquidity facility and enable municipalities to borrow more easily and more cheaply under the $500 billion line that's basically been largely untapped. Also, the Fed has at its disposal the Main Street lending facility. Right now, large businesses having no trouble raising money thanks to high stock valuations and low interest rates on corporate bonds. Situation for smaller companies, much different. Banks really being very stringent on credit and underwriting standards. But the Fed has a facility in place called the Main Street lending facility, where they can lend money out to smaller businesses. So far, only 472 has been lent out, and they have the authorization to absorb losses of $75 billion. That's not loans; that's the ability to absorb losses. So the Fed could make changes to the Main Street lending facility and lend more directly to small business. And finally, the Fed may take actions which could depreciate the dollar. That's always a slippery slope, but a lower dollar potentially would help U.S. exporters. It would help them gain market share from foreign competitors, and it would also loosen financial conditions in many emerging market countries, which would enable their economies to be stronger potentially and for them to invest in more U.S.-based products and services. Barron's actually ran a separate article entitled "It's Time to Prepare for a Weaker Dollar," and what they talked about here is what strategies we as investors could use if, in fact, the dollar is getting weaker. They point to some of the obvious, which is investing in foreign stocks, foreign bonds. One thing they point to is if you are investing in international assets, you want to check and see if those assets are hedged, because if your belief is that the currency is depreciating but you're investing in a fund or ETF that's hedging, you may not be getting the investment that you anticipated. They also suggest taking a look at TIPS, Treasury Inflation Protected Securities, which would be more advantageous with rising inflation because TIPS are correlated to the Consumer Price Index. So if we were to see an uptick in inflation, which is something you're likely to see if the currency is falling, then TIPS would potentially outperform traditional treasuries. And finally, hard assets like commodities. We've already seen some of the benefit of the weaker dollar taking place in gold and oil, which has rebounded somewhat, but that trend very possibly could continue if we were to continue to see dollar weakness. We've got a few more stories, but we're reaching 9 o'clock, and love to hear from Brad. So I'm going to turn it over to Brad to talk some more about markets this morning. Good morning, Brad.
Good morning, everyone. Hope everyone had a good weekend. We are really riding into the dog days of summer here. Things are, even though the news headlines just keep reeling and reeling, it's pretty slow in the markets. The stock market just keeps making new highs, and we just keep moving along. But it doesn't seem on the trading floors that there's a tremendous amount of activity. Rates are low, and they're expected to stay low for the foreseeable future. But what I've seen in my 30-year career in this business is do not get complacent with anything. Never know what event can have an impact on something. And we have a lot of moving parts happening this fall with an election and COVID and a number of other things. So just don't get complacent with rates. Municipals are still the cheapest asset class on the high-grade side of bonds. They are still yielding over 2 times as much as their comparable government counterpart, and sometimes as much as 3 times. Those rates are still low in real dollar terms, but everything in markets is relative. As Keith mentioned before, he was talking about the federal funding facility. The MTA was the second issuer to use the federal funding facility this year to come to market. They saved about 90 basis points on their financing from what the banks were offering to pay. Illinois was the first to use it, and obviously a lot of us are always, as market participants, sometimes we want things to do well, sometimes we want things not to do so well because we're positioned in a certain way. I think that ultimately you do want things to do well because you want a solid country, and if large municipalities have problems, it's problems for a lot more than just the bondholders. We need to separate which issuers had trouble pre-COVID, and you need to still make that determination that an issuer that was having trouble before COVID, who may have a short bailout from the Fed, does not necessarily put that issuer in a stronger standpoint for the long term. For the short term, yes. Some investors see the funding as an opportunity to buy, and some see this as an opportunity to sell. My opinion is that I like selling questionable bonds into strength, and take a second look this fall when we see what happens with COVID and the election. However, if you're sitting on a great rate of return on the bond, you have to take that into account because it's tough to find yield in other areas of fixed income. You do want to make sure that your portfolio is not dominated by issuers that are on life support. So you want to use this quiet time to review your portfolios. That's all I have for today. Hope everyone has a great week, and be in touch.
Thanks, Brad. That's everything I've got.
Thank you for listening to Mr. Keith Lanton. For more podcasts, please visit our website, www.lanternwa.com.